US market is trying to explore correction territory. It's the 16th of March. We are down 10% from all-time highs. And Katie sent me an email and asked me, should I start investing now? Backstory is, I know Katie since she was 5. She's a millennial. I realized, damn it, if a millennial asks you how to invest, when to invest, you're really old now. But I feel obliged to answer her questions. Stay tuned.
Gotta be cool on Wall Street when your index is low.
Welcome, fellow investors. Today I want to have a look into the markets, give you my idea where I think at the moment where we are. Should we start investing now? Should we not start investing now? Which condition is the market? And then I will go further into that topic because I got a very interesting message from Katie, and Katie asked me, and I'm reading it. Good morning, Torsten, last week. Hope you're all well, smiley face. I have watched one of your YouTube videos this morning as I'm looking to start investing in ETFs for 20 to 30 years on an accumulation plan. I'm just wondering if I could pick your brain. Do you think now is a good time to invest in such as the S&P 500 or MSCI World, or do you think they're heading for disaster? Excellent question. So I split it in two. I give you my idea where we are currently in the markets because you're here at the technical brief. And we are not just long-term investors, what we do as well, but we take opportunities of the technical situation we see in the market. And let me start with that here. We have an investment model, and the investment model goes on to the macro side of the business. It looks at market factors like momentum and relative strength in the market. It goes into anomalies we have in the market, and then we work that with a derivatives overlay. Starts with a macro picture. Here first, where are we? Is the economy still growing? Until last week, when the Federal Reserve of Atlanta published their nowcasting model for the GDP, we thought so. Yes, at a healthy 2.3, 2.4. Before that it was 2.8 growth rates in the GDP. Look nice. And suddenly we see a number coming in from their GDP Now forecast in negative territory. Why is that suddenly slipping in, this nowcast for the first quarter? My theory is, under the last administration, numbers always looked much better than everybody felt they really were on the street. Now, with the new administration, maybe the Federal Reserve Atlanta said, okay, fine, now we can show the figures how they should really be. And that is, we are in negative territory on this GDP forecast print for the first quarter they've shown, which is not a positive sign to be invested in markets. Goldman Sachs came out last week and also reduced their forecast for the GDP in the US, not into negative territory, but they've taken them down. So that's a negative point. Then the other big figures that came out last week were CPI and PPI. What are those? CPI, consumer prices. That's what the consumer who spends money on, well, making a living pays out every week, every day. And then PPI, producer prices. The producer price index tells us, do corporations who produce with input they put into their system, are they paying more or are they paying less? So there are two ways of interpreting this. If you have the CPI, and it's not coming in too hot, we'll say not too high, then everything seems to be in hunky-dory. In a growing economy, usually prices, inflation goes up slightly, and we've got used to it. And it's not of much concern as long as the GDP is growing of this economy. Yeah, we need healthy growth rates, then we can accept inflation rates. Because in the long run, production will sort it out. We'll have more products. They'll become usually cheaper in a good economy, in a Western economy, in a capitalist economy, we'll say. And so we can accept that. These are the so-called Goldilocks scenarios or reflation scenarios. Inflation is going slightly up, but the economy is doing fine. There are certain sectors we want to be invested in, especially growth. The high-tech, the artificial intelligence, everything you can think out, these are flavor of the month. Then there's a different scenario. If GDP comes down, means companies are not making that much money anymore. That's a negative print. Where else could you see that? CPI, even though it came down, could also mean that the consumer is not willing or able to pay higher prices anymore for the products. Negative read. Then we have the PPI. came in also below expectations. So corporations, what do they usually do? They buy stuff and they have already stuff in storage to build their products. If they are not paying more, they could have various reasons. Yeah, there's a huge supply, things got cheaper and everything is fine. Or the different reading, which seems to be creeping in, wait a second. They take their supplies they already have stored, then they're also not able or willing to pay higher prices because they see their order books. They see what might happen in the future. Will the consumer still buy my product? If my forecasts are not looking that positive anymore, what am I going to do? I'm not going to pay the higher prices. I'm not desperate to get in there and produce as much as I can because I can sell it to a consumer who's also willing to pay higher prices. So at the moment I have the impression, even though these readings in itself are positive, the market is looking from a different angle. Why do I come up with that? We've seen these numbers coming in far better than expected, and the market did nothing. It fell, actually. There's a change in mindset on the investor side going on at the moment. In this interpretation, I would not be too aggressive at the moment to invest in these markets. Then we have momentum. Momentum, if there are two views. The long-term view is markets are random. In the long run, it doesn't really matter whether you buy today or tomorrow or what you do. There is a growth rate inherent in the market, and you can invest whenever you like. It's the so-called bell curve, and there's good evidence and proof for that. And a Nobel Prize for these observations went to Eugene Farmer. And then there's the other view, that we have something. It's called momentum, and it does matter. Markets are not random. If something is hot today, it will probably be hot tomorrow, and if people don't want to have something and sell it, then they're also going to sell it the next day. There's good evidence for that as well. And Mr. Schiller, Robert Schiller, also got the Nobel Prize for his observations at the same time. And then I always forget the name of the third guy who analyzed whether they were right, and he came up with a framework to test, you're both right, and it makes sense. So the jury is still out there. We have momentum in smaller time periods. In the long run, markets seem, and that's all the evidence you see on this channel as well, if you go in 20, 30 years, markets tend to be random with a growth path, as long as you live in a capitalist society with a positive growth path we have in here. All right, so where are we at the moment? We have correction territory, the technical situation. A lot of people look on these moving averages. One of the biggest out there everybody can observe is the so-called 200-day moving average. If we are below that, it signals us markets are not as positive on the future anymore, because for the simple reason it's not going up. If stuff goes up, everybody's positive, and that's great, and you have the market trading above the moving average, 200-day moving average, the big long-term parameter. We are below that now. Okay, so the next question is liquidity. Is there money coming into the market? And if you look at the US GDP over the last years, it was government spending. Government spent a lot of money, so took debt out, increased the deficit, put that in the economy, and the economy made money out of this. Now we have a different administration in the United States. They talk about tariffs. I don't like tariffs. Tariffs are stupid. Why can't we have free trade? But they're talking about tariffs, which should enable the Trump administration to reduce taxes on their own people. So far, they're only talking about this one side, and the other is carrot and stick. So if the government stops spending a lot of money, less money gets into the economy. That's the explanation why places like, for example, Germany, we live in a proto-socialist society. Everything is being ruled. But the stock markets are doing extremely well. Why? Because stock markets at the beginning always love socialism. Why is that? Because what socialists usually do is they start printing money. They put money into the economy. And it takes a while until inflation filters through. So at the beginning, you say, at the moment we have in Germany, you want to take on 1 trillion in new debt to put into our infrastructure and into our military, into defense. Markets see that positive at the moment because that's fresh money coming in. And we worry about the inflation bit and the horrible things later. You've seen that, by the way, in other economies as well, whether you see Venezuela or Brazil or economies where socialists start spending huge amounts of money at the beginning, you always see a huge spike up. And that's what we're seeing at the moment, because markets do not like if you have a prudent government. And as it turns out, or as we have the first impression, the government in the US seems to or wants to pursue a prudent way. There is Doge, Department of Government Efficiency, which wants to reduce costs. They are thinking about, can we save 1 trillion in spending? Long term, this is great. There's also data out there which shows the lower the debt ratio of a government is, the better it is for the market in the long run. But in the long run, Keynes already said, we're all dead. So we have to do what we have to do now. And for us, as a tactical situation, next point, volatility. We've seen volatilities above 20 now. And I've done a study myself a couple of years ago. I linked the article in here. It was always, if you would invest today and the VIX volatility measure is above 20, would this 1 year portfolio have a good performance or not? Obviously, I didn't only do that on 1 year. I made over several thousands, always 1 year portfolios. And it was pretty simple. If you're below 20, the further below you are, the better it is. You have a nice return on these 1 year portfolios on average. If you creep above 20 in volatility, it stops looking nice. And if you go above 30, then you most likely will lose money until these very raw occasions when there's, you've heard it, blood in the streets, markets are down by 50%, 80%, everybody's selling out, volatility is at 60, 70, 80, nobody wants to buy anything anymore. 2020, Bill Ackman on television, it sounds as if he was crying, no, the markets, the Fed has to do something, otherwise everything will implode, and at the same time he was buying the market low. Kudos, well done. High volatility, that's when it works, but unfortunately not for everybody, because what is the usual investor on the street doing? He buys high and he sells low, because that's the psychology when you are too much driven by fear and greed. So let me sum that up. Where are we at the moment? We are in a period where I do not want to be invested to large sums. There's always the odd stock pick you can take, but the market is still valued very high. We only had a 10% correction. The macro data seems to be turning. We will see how that turns out. The interpretation of good news seems to be turning into sometimes good news is good news, then good news is bad news, then bad news is bad news, and then bad news is also good news. So within that four-folded framework, where are we at the moment? Good news seems to be bad news at the moment because of the political situation we have right now. It's the Trump administration. Markets do not like when they don't, or when they cannot anticipate what might happen in the future. So on a tactical basis, I would wait. I would wait till volatility comes down, whether we know how the tariffs work out, whether they will cut down administration and bureaucracy in these markets, and then there's the right time to get in. So let's come to the question Katie asked me. Should I invest now? Hell yeah, you should. And why do I say that? For the simple reason you asked the question, you are thinking about an accumulation plan, and you want to do that over 20 to 30 years. And that's where, as long as we still live in capitalism, we will have a growth rate. If you go in for 20 to 30 years, it does not really matter whether you buy today, tomorrow, or the next day after. And I've come up with a couple of numbers here, and I'll show you also a website which will show you one of the, or Einstein called it the eighth wonder of the world, compounded interest. The effects you will see on your portfolio if you invest over a longer time period, if you accumulate even small amounts. And you can also see the influence of inflation on your payout, the purchasing power, what you will eventually accumulate in there over time, and the influence of taxes. It's an interesting observation, and as you already spoke about, let's have a look at the S&P and let's have a look at the MSCI. Then I give you an idea. We have a slow working, our own model, which my colleague Falk developed, an investment plan where you don't have too many adjustments, maybe one signal a year where you do the reshifting, but which showed tremendously good performance on the back tests. And we follow back tests because what else will you want to do? We know the economy, the economic relationships that are out there in the markets, and we try to follow these relationships because things are not totally different every time somebody tells you now they are different. If you know how the economy works, how the framework generally works, yes, there are always volatility in the market. You have some variance about what is really happening, but it gives you a good guidance to say, when do I want to be invested? At the moment, our model says we don't want to be invested now. The signal came on Friday evening, so we are getting out of our positions, the long-term positions, on Monday morning, and wait till our model will tell us now is the time to get invested again, within the framework I just briefly explained in here. However, let's go to a beautiful website, which I have linked up here as well. And I'll show you some calculations on the historical data of the MSCI, on the S&P, and what would have happened if you would have invested at any point in time for a longer period you are envisaging. Let's start with the MSCI World Index. We have an average performance on the MSCI. I will put that sheet in here as well, since inception of 8.6%. So what are we having here? I also put the link for the interest calculator underneath this video. In initial investment, let's say you have zero, but you want to make contributions, and you want to do that on a monthly basis, and you have $100, euros, pound sterling to spare. And you start contributing at the beginning of each month. And then what did we say? We said 10.4% is, no, 8.6, that was for 10 years, it went better. 10.6% is interest rate, that's now the return you would put in there, of the MSCI. Over the long run, you said it's compounding continuously. We can also change that. And you have an investment horizon of 30 years. It would simply tell you, every month, at the beginning of the month, I take $100 and I buy an ETF. And in this case, that would be the MSCI World Index. And let's calculate how much money you would generate after 30 years. After 30 years, you start with zero, you would end up with $170,000. Total principal you paid in over this time period, $36,000 US, and you gain total interest on return on your investment of $134,000. Sounds pretty good, yeah? 30 years can make a huge difference to have $134,000 in interest and an ending balance of approximately $170,000. However, what have we not calculated? Long-term inflation rate, 2.7. I checked earlier over this time period. So what does it show it? We still have an end balance of 170,000 pounds, dollars in this case. Sorry, Katie, you're British. I'm thinking in pound sterling. But what is of interest for us is the purchasing power, buying power of the end balance after inflation adjustment. So how do I have to interpret this number? Very simple. Just look what $76,000 could buy you now, and after you've done that 30 years with an inflation rate for the future, which could be higher, could be lower, of 2.7%, that comes out an equivalent, the $170,000 could you buy the same stuff you could buy today for $76,000. Okay, that's one part of the equation. Let's assume you also are a law-abiding citizen and you have a tax rate of 25% of capital gains. Buying power. Suddenly, you are at $50,000 in buying power after 30 years. Again, the 50,000 stuff you could buy today with, that will represent your end balance of 110,000 in this case, because you have paid taxes on this investment at the MSCI World Index rate of 8.6%. Okay, let's take the tax rate out and assume you are totally efficient, tax organized, and also let's take the inflation rate to a more believable and easy to calculate 3% for the future, because it seems as if the times of zero inflation, zero interest rates are over. And let's play now with the number we have seen for the S&P, 10.3%. One Additional remark, we always reinvest the dividends that come in. Yeah? If you buy an ETF, it has a payout, you take these dividends and reinvest them, of course, into the market to come up with these numbers. So what's happening with my 10.3%? Suddenly we are at 245,000, and that gives you the equivalent buying power of what you could do with 101,000 US dollars today. Okay, looks a little bit better than the MSCI. Why am I saying that? If you want to diversify and say, oh yeah, go for the MSCI World Index. 72% of the MSCI World Index is United States. So I'll say a point to diversification in a moment, but if you want to trade the real thing, the United States, go for the United States. So in this case, we had a average annual return over the last 20 years of 10.3% if we reinvested our dividends. An inflation rate of 3% for the future will give us the return of 101. I'm claiming the bragging rights. The model we are using has a slightly higher performance in here, and it gives you about 1 to 2 adjustments of your portfolio. Your portfolio in this case would be S&P. In a year, and it follows the simple procedure. There are times where I want to be invested, and there are times where I do not want to be invested. I said that a little bit earlier. We have now reached a signal where our model tells us do not be invested in the S&P now. So we are closing out our positions on Monday and put that into a money market fund. Yeah? You still get interest on that, but we have high volatility and the market could make a further correction. We've seen corrections in the past where markets lost up to 80%. NASDAQ in the 2000s. For the millennials, we had the dot-com bubble. You might have heard about that. And the NASDAQ actually went down by 80%. So this protects us to, yes, market goes in a downtrend. We've already lost from the peak 10%, but we've been invested a pretty long time in our portfolio. So you will not get out of the first hit, but what we are doing is we're being prudent and we want to have this as a long-term investment portfolio. What are the returns on this portfolio, which works with the approach, broadly speaking, you can see here at the moment. And we would have backtested a performance of 18.3% in our portfolio. That's a comma. I should use a dot. 0.3%. Just have a look at the ending balance, 245. That is the S&P return. If you would just follow a buy and hold strategy. Let's calculate. We arrive at 1.594 million, or purchasing power today of 656,000. That is what you could buy today. Purchasing power for the 1.6 million you most likely will end up if our model was accurate. And we see in the future these performances we've seen on average over the last years. However, this is a long-term average we have in here. Yeah? At the moment, we anticipate that for a couple of years, we will not see huge returns in the S&P. Even if our model takes us in again, there's a difference between whether you make on average a year 10% or 3%. And if markets go down, we are not invested. We are in the bond market, and the bond market will give us a measly, is that the right word? A meager 2, 3, 4% return in safe assets. However, over the long run, when the market recovers and you invest it again, then you have years where the market does 20, 30%. So the long run here is the most important. What do you do as a private investor with that information? You don't have the time, you don't have, the know-how to get into the details to follow that like a professional. You could buy a fund, go for a good fund manager out there who has a proven track record and gives you a little bit of a better return you have in here, or you could follow some simple rules. I've already mentioned it. The MSCI World is 72% plus in US stocks. The S&P 500 is 100% in US stocks. So mix and match. Yeah, and do it in a way that you want to buy diversified. Look at the economy. Yeah, what do we have? Let me get that a little bit smaller. What do we have as the largest economies in the world? You can see this sheet, which I have in the background now. That's the 5 largest economies plus some extras. Yeah, United States 25% of world economy, China 18%, United States, European Union and United Kingdom at 90%, Japan at 6%, India at 4%. It's a combined total of 72% of the world economy, we can see here. So we also want to have a little bit exposure, hopefully, to the emerging markets. If you use the MSCI Emerging Market Index, obviously there's China in there, there's India as well, but there are a lot of products where you can pick and choose and say, fine. So that is another 21% of the whole world economy in GDP terms, which brings us up to 93. So the world is your oyster. You want to invest in the world, and you do it by diversifying your portfolio. How are you going to do that? At the bottom, you can see we have the S&P 500, the biggest indices for these economic regions, Shanghai Composite, Euro Stoxx 50 and the FTSE 100, Nikkei 225 and the NSE Nifty 50 for India, and you can go for a variety of MSCI emerging markets ETFs you have out there. As a private investor, what do you want to do? When you make decisions to buy stuff, do you buy them when they're really expensive or do you buy them when they're cheap? Facilitate that also in your investment process. At the moment, the S&P is really high. It could be even higher in a year's time, 2 years' time. There will be corrections. There will be corrections in your Brazilian investment. There will be corrections in your German investments. If you have a long plan, and this is the 20 to 30 years plan you have in here, you simply say, fine, I'm buying something now. And when the market corrects by 10%, I'll buy some more. And when the market corrects by 30%, I'll buy some more. You couldn't even stagger that up. Instead of using this every month $100, you say, fine, if the market has fallen by 50%, will happen. Then I'll buy some more. If the market has fallen by 80%, I'll buy even more. You want to buy cheap because this will give you over a longer investment horizon better returns. And you've seen just a second ago in the accumulation calculator, a couple of percent can make a huge difference whether you can send your kid to Hull Comprehensive or to Harvard with all the perks that come with it. As long as you follow the 20 to 30 years rule you have in here and have diversification. Why I'm banging on with diversification? If you would have invested in Nikkei all your money in the 1980s, it took 20 years actually to get your money back. So we want to be diversified. That usually takes a little bit return out. You might get it right, but it also takes volatility out of your earnings. Message, if you're a tactical trader, I'm not invested at the moment in the market, or we will be out on Monday. Hopefully there's a nice rally now, a counter rally into the correction trade we have here. And then we will be on the sidelines with our long-term investment cash parked until we get the signal to get invested again. Hopefully that happens after the market made a huge correction. I don't want to have a huge correction, but I want to get into the market after he's made a nice, decent correction, stuff is cheap again, then I want to be invested again. If you don't have the time or the ability or whatever and want to just make prudent financial decisions, it doesn't really matter. Over the time horizon, Katie, you told me 30 years, you're well done. Just diversify a little bit. Put something in Japan, put something in India, put something into China, put something in the United States, and put something into Europe. One of these guys will make it, and what I've learned from my colleagues who are heavy on the Bitcoin side, always have a little chunk in gold, and you might even want to do that physically. Buy yourself, I don't know, a tenth of a Krügerrand once in a while, put it somewhere in a cupboard or bury it in the garden, because you don't want to have paper gold for these purposes, you want to have real gold, and a percent of your portfolio, I've learned that the hard way because I didn't do it, should be in something like Bitcoin. Go for the big ones, or maybe even an index for cryptocurrencies. Why I'm saying that? Volatility is extremely high. So if you have 1% long-term in your portfolio in these, let's call them esoteric assets, but they can make 100x, 200x, 300x, it will have a tremendous effect on your long-term performance in your portfolio. Worst case scenario, they'll go to zero. Will you really be terrified by losing 1% of your portfolio? Most likely not, right? Because you've done everything right. Otherwise, you were diversified. Also hedges you against the currencies, actually. If you're in all of the major currencies, one against the other, you have a good portfolio there. You don't have to worry too much, and you do the prudent thing. Every month, little bit of your money in there. When the market is cheap, you buy a little bit more. If it gets cheaper, you buy even more. Because as long as we believe that we are living in a capitalist society, or at least in a market society, the creative power of entrepreneurs out there will lead to a growing economy. A growing economy gets transformed in corporations that make more money. More money makes more earnings, higher dividends. And as the market share grows, wealth will grow, and you will have a fantastic portfolio after these 20, 30 years to say, yeah, even with inflation, even with the purchasing power reduced, and even if I have to pay taxes, what is the alternative you have? Not really anything else. So I hope that helped you a little bit, Katie. And the disclaimer, everything I did today was for information and entertainment purposes. This is not investment advice. And if you have any questions in the future, not just Katie, but we call this one Dear Katie, please let me know. Hope to see you soon. Bye-bye.